under the Endowment Management Committee of the University of Houston System Board of Regents. Is everybody here? Yeah. I guess we are 4 committee members here out of 5, so we have a quorum. We have 7 agenda items listed. 3 action items requiring committee and board approval. 2 agenda items requiring committee approval only, and remaining 2 items for information only. After our action items have been presented, I will ask the committee if there are any questions and call for a vote. If circumstances are warranted, I will then seek a motion to place the appropriate items on the board consent docket agenda for the final board approval. The first item requiring committee approval today are minutes from the Endowment Management Committee held on August 20th, 2015. Are there any corrections to the minutes? Is somebody making a motion? May I have a motion, please?
I'll move approval.
Second.
Second?
Second.
All in favor?
Aye.
Please say aye. The minutes are hereby approved. We have 4 representatives. I see only 3, I guess 4th one is coming. From Cambridge Associates for our meeting today, who will be presenting several of the items listed on your agenda. After discussions and any recommendations from the Cambridge Associates, I'll call for a vote. Please note that any recommendations from the Cambridge Associates require committee approval only. First 3 agenda items listed on your agenda will be presented by Cambridge Associates. Item C, the report from Cambridge Associates regarding the U.S. system endowment and non-endowment portfolios. Item D, approval is requested to delegate authority to the Chancellor to negotiate and execute contracts for the hiring of private investment managers for the University of Houston System Endowment Fund. And item E, the approval is requested to delegate authority to the Chancellor to negotiate and execute contracts for additional investment in existing hedge fund managers in the University of Houston System Endowment Fund. Mr. McShane.
Thank you.
Interim Vice Chancellor for the Administration and Finance, will you please introduce these items?
Thank you. Good morning.
Good morning.
I'd like to introduce our 3 representatives from Cambridge here. First, the new face in the crowd is Terry Kirk. He's our new lead investment consultant. Expect him to do a great job. Then we have Catherine Chu, who you've met before, as well as Aaron Schumacher, who you're familiar with. So the first item will be Cambridge's report on the endowment and non-endowment portfolio.
Okay, as a new guy, I need to ask, is this on? Can everyone hear me okay? Okay. Well, good morning, Regents, and good morning, everyone else in the room. It's great for me to be here with you all. I'm happy to be joining the team and in our important work in stewarding the assets here on behalf of the University of Houston System. The only thing I'll say by way of background, as you've had previous information on my bio, is that in June I'll complete 21 years of doing institutional investment advisory at Cambridge Associates, specifically to nonprofit tax-exempt endowed institutions, most specifically college and university endowments, but also large philanthropic foundations as well as healthcare systems. A number of my clients are billion plus, and of course that's where we're targeting to get the University of Houston over time. I'm reminded of your motto, in time, but we're going to work for that. I have had numerous conversations and 3 visits in the last 4 weeks down here to get my feet wet and to begin to hit the ground running. So with that, I'm going to refer you to our materials. Hopefully you either have it on your tablet or in hard copy. Under tab Executive Summary, okay, slide 2. This is the slide that, if you have no other time but to read this, this is it. It's a new slide that I'm introducing for this meeting as a best practice to indicate what we have for you today. So I'm going to start and take hopefully no more than 15 minutes in making some, as the new guy, making some observations about the strategic endowment plan that was adopted by this committee last May, largely with an eye, fortunately, towards reaffirmation of the decisions made at that time and the directionality of that strategic plan. But I also want to introduce some what I'm viewing as observations that perhaps would serve as enhancements that we could take up across the calendar year 2016 to that plan. I will then turn it over to Aaron, who will summarize investment performance and say a few words about what's been transpiring the first part of this year, because things have actually gotten quite a bit interesting, as most of you know. Catherine Chu will represent the private investments recommendation, and then Aaron will finish up with the hedge fund recommendation. With that, please turn to slide 3, and I'm going to start by reorienting you, and in my case, orienting myself in the first place, with regard to what has been referred to as the Strategic Endowment Plan adopted May 2015. This is a very busy slide that you need not read completely, but you've seen before in the May material, so it should look familiar. But if you could focus your eyes really on the right-hand side of the page, which is where I initially went, you can see the directionality of where the University of Houston system was currently, far left, the peer group that's currently being considered, and then this notion of near-term targets and long-term targets. And the colors tell the story where, in essence, in light of the risk tolerance and the lack of the proportion of the endowment that is operational budget support is low enough that you can take a more of a leaning forward risk posture and a lower reliance on the endowment for the annual budget, that what we were advocating at that time was increasing the growth and diversifier segments while reducing the defensive segments. And so on the right-hand side, I really see 4 themes here. Number 1, increased growth assets. Number 2, particularly private equity and venture capital. 3, in the near term, increased diversifiers, also known as hedge funds. And in the 4th one, lowering the defensive assets, principally cash and fixed income. And so I considered those themes, and as you turn to slide 4, where I really codify them there or enumerate them with these big green check marks to basically say strategically. And when I say strategically, I mean notwithstanding the turmoil and the sort of vagaries of the markets today, or even for that matter, any year-over-year period. These are thematically and directionally smart moves for this endowment to take. So I reaffirm that at least 50% of the portfolio should be in growth-oriented assets. In fact, the strategic plan took it from 53 to 55, and you'll see in a moment that in 2016, I'm going to suggest we move that up to 57. Number 2, there's been recognition that historically the endowment has not participated in the private equity markets as robustly as perhaps it can, and that also is being changed by the strategic plan, significantly increasing that target for investment. However, we all need to recognize, and I think it's been covered, that just having a higher private equity and venture capital target does not translate into higher returns. You have to do it well. The average return to these markets are about what they are in public markets unless you get the right managers and do it well, and do it, again, across time. The third observation on slide 4 I want to make is that, at least until January and February, valuations in most of the global equity markets, particularly the U.S., were quite rich. And arguably, the U.S. market is still in the higher end of fair value, even with the sell-offs in January and February. And so while this private equity exposure is being built and these growth exposures are being built, that's why the near-term exposure to increased diversifying assets or hedge funds as a middle ground stance makes sense. So I reaffirm that. And then finally, the 4th bullet point is, I know it's difficult, particularly in January and February, we see what's happening to global equity markets, and particularly the energy and the commodities complex. But despite their significant lower volatility, fixed income assets, safe fixed income assets, are really priced for, depending on inflation, of course, unless you make heroic assumptions about inflation, are priced for flat to negative real returns over the next at least 5 years. So with that, on slide 5, I would just want to answer the question, how did we propose this numerically? Again, this is where you are today, and so I'll not belabor the actual numbers. Actually, to steer us and to be helpful for orientation, we decided to use these clever green boxes and red circles to indicate in the growth-oriented asset classes, this notion of near-term and long-term, you will see the reductions in U.S. equity near-term with increases in developed international, developed markets, international, which is emerging markets, private equity, venture capital, hedged equity, absolute return, marketable inflation hedge, and then the reduction in fixed income and cash for the near term. So it just shows how that directionality is being expressed. And in the long-term targets, significant increase. So reading all the way over to the right, you'll see the check mark where we have a substantial increase in growth assets, 12%, up from the 53, the current asset class 53. So up 12%. And then the reduction in fixed income, cash, and then the absolute return portion of hedge funds. So these really are the facts and circumstances when I came on board. And again, thematically, directionally, I endorse those. I think they're sound. But then I asked the question, number 6, with a fresh set of eyes, can the strategic plan be enhanced? Can it be improved? And I think that it can. And I think, well, I have a number of observations here that I want to share with you, but they all fall under 2 categories. Those that are specific to the portfolio and those that are more policy-oriented and monitoring enhancements that you need to do if you're going to do any of the Category 1 modifications. And so this seems like a lot as you look at it, because it's about 8 different observations. But some of these are labeling, nomenclature, changes in flexibility that I'm going to explain in a moment that are modest, at the margins. 1 or 2 of them are a little bit more meaningful, but in no way do any of these observations reverse or repudiate in any way the directionality and the themes I was just mentioning. So with that, rather than belaboring the individual ones, I'll take you to the next slide where they are also listed. The first of which is to reclassify certain assets. And in this case, I'm going to show you just 2 more slides that indicate how this would work if it's adopted over the course of the year. But under the reclassification of certain assets, we are talking about creating a global equity category, which you sort of have, but you sort of don't. Now that sounds cryptic, but I'll show you what I mean by that. One area where we will rename the privates, I would propose to rename the private investments category specifically to represent venture capital and private equity, and not all private investments. Rename the marketable inflation hedges target real assets, and I'll say why. The second proposal is to just simply streamline some of the sub-asset class targets, which is really in line with the first proposal, which is essentially to get rid of individual targets to U.S., non-U.S., emerging, but keep the ranges. And I'll say why that's important. Number 3 is to update and modify your near-term targets, because in one case you're pretty much already at it when I looked at it. And with some of the reclassification, with the real assets category being formed, we need to update the near-term targets. But you'll see it's at the margins. Number 4 is to delete one category, marketable inflation hedges, and create one new to replace it, real assets. It's just more in keeping what I see in the endowment management asset allocation policy construct out there today. And it allows you to have exposure to both public and private real assets in one category rather than having the private real assets in with the venture capital and private equity. Again, that may sound like a little inside baseball, but I'm going to show you on this slide in a moment, a little more specific. And then finally, number 5, on the policy side of enhancements, some modest streamlining of the manager structure, particularly in the global equity and the long-only space. This is where there's still TBD, but Aaron and I are looking at some of the managers in that space, and I'm seeing where you could perhaps lose 1 or 2, and particularly when you're going to be proliferating the manager structure in other spaces like the venture capital, private equity, and the private real assets. It would be a modest reduction, but I think it would allow for greater efficiencies, perhaps in cost, but certainly in what we call active share, active risk, to where we would be more specifically targeting manager alpha, manager excess return over benchmark. The bottom half of the slide, I won't say too much about other than to say 7 and 8 would be modifications to performance reporting and benchmarking, which would be simply consistent with any or all the proposals above that get adopted. So if you change a asset class target or you create a new target, you need a new benchmark for it, that's all. And that would be proposed alongside the proposal above. I left out 6, but I want to mention 6 is just that since, again, I'm new here, at least with the University of Houston, I think it's important that we step back probably at the next meeting and just reaffirm what I call the hierarchy of the definitions of success for the endowment. Typically, when I say a hierarchy, that means there are several levels, of course, and some are more important than others. And most typically, the objectives that are institution-specific as it relates to absolute return, maintenance of purchasing power, maintenance of intergenerational equity, meeting a spending rate, meeting the total fund benchmark, meeting individual asset class benchmarks, meeting individual manager benchmarks, and then comparing your results to peer institutions or other institutions. Just having a conversation about that hierarchy and just essentially reaffirming what that is and what that should be as our lodestar. Okay, checking my time. Okay, I only have 2 more slides, and then I'll see if there are any questions on this, but much of this will obviously spill over, I believe, into the next meeting and beyond. But slide 8 looks at what these first 5 modifications, what it would look like at the proverbial first layer of the onion. And so the first one, when I talked about streamlining asset classes, just look up there on the left-hand side, the current policy target classification. And you see that currently the University of Houston has 3 global equity targets. I don't list the targets here, but you have targets to U.S. equity, developed international, and developing markets. We will simply be proposing that you aggregate all 3 of those into a single global public equity target. That includes those 3, but the target at the policy level is just one global equity market. Secondly, under hedge funds, there are 2 targets, hedged equity and absolute return. Similar concept. Rather than having 2 policy level targets that happen to be 10 and 10% each, let's aggregate that into one overall marketable alternative / hedge fund target. And then I'll show you on the next page how we look at the ranges. The private investments target remains, but we changed the name of that to private equity / venture capital to recognize that we want to distinguish between non-venture private equity, leveraged buyouts, venture capital from private forms of real asset investing, which is your next category. Currently, it's called marketable inflation hedge. I would like to call that real assets. And of course, real assets include sort of, it's worse than hedge funds in terms of the dichotomy of underlying strategies. We're talking natural resources equity, infrastructure, alternative energy, commodities, real estate, treasury inflation protected securities, metals and mining. These are all forms of real assets, some of which you obviously have exposure to on the marketable side and on the non-marketable side. What we're doing here is just taking the non-marketable part out of the venture capital private equity category and pulling it into the real assets category along with the marketable, what you call now marketable inflation hedges. One reason for getting rid of the inflation hedge term is simply a personal, I guess, bias of mine that is not just a bias. I just think it's very, very difficult to scientifically hedge against inflation. And any implication in policy called inflation hedge carries a connotation that will be difficult to realize. It's short, sharp hyperinflation that is really deleterious to equity returns, and that's very, very difficult to hedge against scientifically, unlike bonds, which can very scientifically hedge against deflation and falling interest rates or rising interest rates for that matter. Bonds and cash, fortunately, no change. They are what they are. And then finally, the next layer of the onion. And this will show you how much or little change there actually is. In some cases, it's quite modest. But under the asset classes where I said you had 3 targets, U.S. equity, developed and developing or emerging markets, we simply go from the 17.5, 7.5, and 10, which equals 45, to a near-term target of 42 and a long-term of 40. Long-term hasn't changed. The target is one target, global public equities, but we keep the ranges for the individual. Why? To provide latitude, to provide flexibility. so that we're not structurally bound by targets to these individual subcomponents that, for example, right now are having us, structurally overweight to emerging markets and feeling the pain. Not that we're going to be overly tactical in sort of trying to dodge bullets per se, but we want the flexibility to be more in non-U.S. than U.S. or more in developing than developed. And so you keep the asset class exposures, it's just you take off, instead of having belts and suspenders, you have just a belt. You take the suspenders off, so to speak, as the saying goes. It's the same concept in hedge funds. Instead of having two categories, you have one category and you keep the ranges. That'll allow us to modify the exposures between absolute return and hedge funds. Private investments, I already mentioned that, but here you'll see that the near-term target remains 10, right? But currently, if you add together all your private investments, at least that's for December, a little bit of a denominator effect in January and February, you're at 11%. You take those real assets out and put them in the category I want to put them in, real assets, then you're right around 7. So that 10% near-term target is good, just for private equity and venture capital. That's good. The 20, and I'm suggesting a 20% long-term target, and you may be thinking, wait a minute, I remember from the last time we went to 25 in private investments. And you'd be right in saying that. You would still have a target of 25% in private investments. It's just that 5 of it is in the real assets category, under private real assets. So private real assets, or real assets becomes 10%, not 5. Half of it public, half of it private. So you're still 25 when you add up the long-term target for privates. I simply take the bonds and cash down a little bit because I believe, again, notwithstanding month to month or year to year vagaries of equity markets, that this is going to be a long-term drag on the endowment's performance. It's an opportunity cost that we want to try to minimize, particularly given the relatively low annual support to the operating budget provided by the endowment, but also the liquidity you have in the non-endowed pools. When it's all said and done, the exposures in terms of growth, diversifier, and defensive doesn't change very much. It just simply leans a little bit further forward towards growth, 55 to 57. Diversifier stays the same. Defensive goes down to 8 on a near-term basis. On a long-term basis, you remain at 65, 25, 10. I've just thrown an awful lot at you. I should say that none of this is proposed as action item in this meeting, or it would have been mentioned. These are ideas to show that I've given some thought to the portfolio. Back on slide 7, although you don't need to turn to it, but I would say that there is a potential time frame column in effect if directionally you're okay with us putting together proposals in this regard for action. Most of these could be proposed for action at the next meeting, and maybe some of the follow-up in terms of the benchmarking and performance reporting in the third quarter. I'll pause there because I probably went over. Sorry. See if there are any questions about any of this, or
I guess somebody is going to be presenting item D. This was for information only. No vote is required on this item.
yes.
So, Mr. McShane, who is going to be presenting item D?
I might just throw in, Mr. Chairman, I personally like the direction that you suggested here, and I think if in the next meeting, you bring up policy proposals together and investment proposals that go this direction, I personally am comfortable with that.
Thank you. Thank you
Sure.
for the comment.
Okay, the next item is the approval is requested to delegate authority to the Chancellor to negotiate and execute contracts for the hiring of private investment managers for the endowment fund, which will be presented by Cambridge. Did we jump something? What's going on here?
Oh, do you want us to review performance first, or just jump into the private investments?
Would you like a brief review of the performance? Okay. So this is to be a continuation of the first item, which is just a report on the endowment fund before we move to the next item, which will require action.
Sorry, okay, I will
Yeah.
be brief here. I'm gonna draw your attention to page 11. And we'll focus on kind of looking back at 2015. It seems like a long time ago now, but the first half of 2015, markets were relatively calm. As we moved into the second half, however, and we've talked about this at prior meetings, macro concerns about slowdown in global growth, Chinese government devaluing their currency, and then further weakness in commodities really caused macro headlines to dominate, and markets began to sell off. You can see in the top page, the top graph on page 11, we did get a bit of a rally in the fourth quarter. However, then focusing on calendar year 2015, you can kind of look across these asset classes, and I would define this as lackluster and somewhat challenging. Really, there was no great place to hide, which did make it somewhat challenging also for diversified portfolios. So looking within equity markets to the far left, you can see in 2015 that this positive 50 basis point return is reflective of the return of the Russell 3000, which is the benchmark that U of H uses. The one market to eke out a positive gain. However, if, in the spirit of peeling back the onion, if you peel back the onion on that return, it was quite narrow in terms of the strength we even saw in the market. So a handful of stocks, Facebook, Amazon, Netflix, Google, were really driving those returns. And if you start to look beyond that, very quickly, if you take those few handful of stocks out, your return would go negative. So pretty challenging markets for active managers. Again, kind of just moving international, the US dollar continued to be a headwind. And then Carrie alluded to the weakness that we've seen in commodities and natural resources, which persisted for most of the year. Finally, I would just say to recap, if you look on the far right part of this page within bonds, not providing the same level of cushion that investors have perhaps become accustomed to, in part because of the Fed finally deciding to raise rates and just divergent monetary policy across the globe. So that's just a recap of markets. Turning to page 13 and 14 looks a little bit further into the University of Houston's performance. Looking at calendar year 2015, the portfolio was down 3.6%, which compares to down 3.3% for both of the benchmarks. In terms of drivers, in 2015, the managers within your international developed equities performed quite well. And being underweight to inflation hedge would have been a benefit relative to policy. On the flip side, and Carrie alluded to the structural overweight to emerging markets, those assets from a valuation perspective were attractive and only continue to get more attractive, but that certainly has been a detriment to performance thus far. And the managers with inflation hedging, I think, also struggled a bit. So turning to page 14, looking at the bottom of the page, I guess just a couple things to point out before I get into performance. I think it's worth noting that there has been transition in this portfolio. So as part of the strategic plan, you will recall, beginning in May and into the third quarter, there were significant manager changes specifically within the U.S. equity structure, as well as emerging, as well as hedge funds. And so while we're looking at 1 year of performance here, for many of these managers in the portfolio, they've only been in the portfolio for a quarter or 4 or 5 months. So I think it's hard to kind of isolate this 1 year in a year of transition. With that being said, within the U.S., the portfolio does tend to have a little bit of a value bias, so that was going to be a headwind on performance. Your one growth manager, dedicated growth manager, Columbia, was invested in names like Facebook and Amazon and actually outperformed their benchmark by a decent amount. So you were getting some of that exposure, but the preponderance of managers tend to have a more value tilt. I think it's also worth pointing out international managers did quite well, both on the value and growth side, outperforming the benchmark. It was a somewhat challenging year for hedge funds in the back half, particularly as it relates to event-driven and credit. And you kind of saw a dichotomy in your long-short managers where a handful did really well, and then a couple of the more deep value-oriented funds kind of offset that with losses. However, that specific area of the portfolio, managers have been in there for a quarter or less. Marketable inflation hedge, I referenced the struggle there, particularly Van Eck, a manager that tends to they're not going to invest in the ExxonMobil or the large integrated companies of the world, and the smaller cap companies within the commodity complex were hit even harder than some of the larger ones, so they tended to underperform. Page 15 just gives a snapshot of asset allocation. You can see relative to current targets, we're pretty much in line. Again, a slight underweight to marketable inflation hedge as it stands today. And then the other thing I would note is just within bonds and cash, you'll see an overweight to cash and kind of flat to underweight bonds on an aggregate basis, which is where the portfolio has been positioned, as Carrie referenced, just given where valuations are in the fixed income market today. I know January has been quite busy, so I didn't want to.
And February.
Yeah, and February. We didn't want to pass over it. I do know we are tight on time. Just in terms of an update quickly, in terms of where markets are through, I guess, yesterday. You can see on page 18, through January, global equity markets were down, in the mid to high single digits, which is basically where they stand today. So we certainly have entered 2016 in a risk-off environment. The same themes that sort of plagued the markets last year continue to rear their heads. In terms of, I'm going to go ahead and just skip to page 21. In terms of what that means for the portfolio, we thought it would be worth just kind of updating you. Based on early estimates, we were looking down around 3.6% through January, which is certainly half of what we saw in equity markets. I do think based on some late numbers that we got that this will go up a little bit. Some of your managers have tended to protect capital, and for this estimate, we were using market index proxies. So I do think you'll see this go up, but certainly the start to this year has not been one that makes us feel warm and fuzzy. But, and coming off of kind of a lackluster 2015, I think markets are certainly challenged at this point in the cycle. Any questions?
So
I
are
know
we down 3.6%
That's an estimate, yeah,
total on the portfolio
Yes.
year to date.
in 1 month?
Which, so it's about half of the decline that you saw across equity and risk assets.
Right.
Yeah.
And last year was 3.6%
3.6%.
negative for the whole year, right? So January was not a good month for.
No.
No,
And how do we compare to our peer group or even bigger peer groups? Did everybody kind of take the same hit?
So the themes that have been plaguing this portfolio with respect to kind of the overweight to emerging markets and the inflation hedging allocation are consistent throughout. Go ahead.
I've seen a range thus far, and they're still coming in of -2 to around -5. And, a lot of it depends, again, somewhat on the degree to which the institution has private investment exposure where the marks aren't in yet. They come in on a quarter lag. But I'm seeing a range of, depending on, your hedge fund exposure, your fixed income exposure, -1.5 on the good side down to -5.
So, yeah, so go ahead.
Now, what's your expectation for marks on a typical private equity portfolio here in the first quarter? What do you expect to see?
So I think that because we're on a quarter lag, we're still trying to get to the fourth quarter marks, and those will probably not come in until April with the year-end audits. So I think with private equity and venture capital, we're starting to see a little bit of a pullback. I would still expect that the marks would be favorable compared to public market equivalents. So when we think about benchmarking the private investments portfolio, I think a good public market equivalent is the Russell 3000, which is a good mix of bigger and smaller companies, and I think representative of a diversified private investments portfolio. So the Russell 3000 in the fourth quarter of 2015 returned 6.3%. We would expect that a private investments program would probably be between 5 to 7% if it were to mimic the Russell 3000. Energy is a different story, of course.
Yeah.
And I think that what we are hearing from our energy managers in the private space is that there is distress, but they feel as though the worst distress is still coming. So at this point in time, it sounds as though banks have been somewhat lenient toward the private energy managers because the banks would rather not own energy assets. So I think the idea is that a lot of the hedging that has been in place for the last year is going to start coming off later in 2016, at which point I think that we will see more distress in the market. So the marks we would expect them to come down in Q4 for energy managers, but I would expect it to be less severe than you saw in the public markets in Q4.
And what % of our private equity investments to date are energy, do you reckon?
I think it's 2% exposure.
Oh, that's all?
Yes.
Now,
So it will grow over time, but
Right,
currently.
but there's only 2% exposure to, for the private,
On the
of the
private-
private
on the
equity or the
private
total
side.
fund?
Yeah, on the private side. Yeah, 'cause there's the marketable,
Yeah, I'm asking the percentage of the private equity, only 2% of that
Oh,
is?
sorry. The entire privates program, it's 2 of 11, so about 20%, I guess. So of the entire portfolio, including.
Right, so
marketable-
10%.
yeah, as of year end, your private investment exposure, including private equity venture capital and all forms of private real assets, was about 10.8%, so rounded to 11.
And energy was 2 of that 11.
Right, so energy was two of the 11,
Got it.
roughly 11.
Yeah, so a fifth or so of,
Yeah.
yeah, so we're not overweight in
No.
energy,
No, but it's still painful, yeah.
just by it may be dumb luck.
Yeah,
but
we got all the pain on the marketable side
Yeah.
of the real assets, right?
And, on the private side, one of the things that we consistently emphasize is that it's so important to choose the best managers, because I think that you could see quite a wide range in the best performing and worst performing energy managers. So the ones who were not deploying capital prudently, if they invested it all in 2014, for example, I would expect that they probably got hit harder than some of the managers who saw that prices were high. And I don't think anybody foresaw the decline in oil prices to the extent that it's happened. But, I mean, we've certainly heard from some managers that they could feel some tremors. So you'll see some variation. And as I look at your energy managers, I feel very confident in the ones that you've chosen top managers. So I think that you will see marks down in the fourth quarter, but relative to other managers, I would expect it to be less severe.
Yeah, and hopefully those managers can take advantage of the low pricing now and kind of double up and,
Correct. And I think what we are hearing from those managers is, yes, there are some bargains to be had right now, but they expect the better bargains to come later in the year when there are some more distressed assets where people's hedges came off and the banks are maybe not as willing or able to renegotiate loans or to give leeway on covenants. So what we're hearing from the energy managers is that they have been, or the ones that we think have been a little more prudent, they've still been holding on to their capital and not deploying a lot right now. They're trying to hold on to that dry powder for later. And along with the slower capital calls for this year and the end of last year, just as a heads up, I would expect the distributions from those managers are going to dry up pretty significantly this year. So I think the cash flows will look a little different. Okay, I know time.
We need to go maybe to page 24.
Okay.
Page 24, maybe?
Yeah. Thank you. The next item will be the approval is requested to delegate authority to the chancellor to negotiate and execute contracts for the hiring of 2 private investment managers. I might note that this is consistent with our plan to increase our investments in private equity, so.
Okay, and I'm ready to go. Sorry for the
no
deer in the
problem.
headlights
Thank you.
moment earlier there. Okay, so we had 2 recommendations, one of which has already been reviewed and approved. So we have that available for review if you wanted to see that. The recommendation that we will talk about today in this meeting is Jackson Square Ventures. So I will get to that in just a second. I know we're being careful of time. I would just point out a couple things on page 23, which is the first page in the private investment section. You can see that the NAV, which is the net asset value of the private investments portfolio, is currently at 60.8. What I wanted to point out is the column next to that unfunded is 105.7. That is significantly larger than the NAV number. And I just wanted to explain that unfunded is the amount that has been committed but not yet paid in. And because this is a growing program, we would expect that the unfunded number will be larger than NAV for some time. But over time, the program will be self-funding. And then distributions have been strong so far, but as I mentioned before, I think that the expectation for this year is that distributions are going to be a little bit slower given that the market has pulled back a little bit. With that, I think, please read the following pages at your leisure. I think that the performance of the portfolio has been good so far. Since inception, the private investments program has returned 15.1% net IRR, which I think is a great number. And then I will go ahead and skip ahead to page 28, which is where our recommendation for Jackson Square Ventures 2 is located. Jackson Square Ventures is an early-stage venture capital manager. On page 24, we had the portfolio, and if you looked at the venture capital part of the portfolio, you'll see there are a fair number of names at the top of the page that are fund-to-fund exposure to venture capital. With this dedicated private investments program, which is also growing, we of course now want to focus primarily on direct investments and have less exposure to fund-to-funds. So if you look at the direct venture capital investments, you do have some early stage exposure. For example, SV Life Sciences will invest early stage venture capital, but they are specifically dedicated to healthcare. Live Oak Ventures is also going to invest in early stage IT. They are a Texas-based manager. What we think that Jackson Square brings is a dedicated early stage manager that does most of its investments in California, with some exposure to other parts of the United States. So we think that this is a very good fit for what you already have in the portfolio. This would make a good complement. So what we are recommending today is a commitment of $7.5 million to Jackson Square Ventures 2. A little bit of history on this manager. The partners at this firm were originally part of a firm called Sigma. Sigma has since split up into two groups. There was Sigma Prime, which was focused on East Coast investments, and Sigma West, which was on West Coast investments. So Sigma West recently renamed itself to Jackson Square. So even though we're looking at Fund 2 for this manager, which makes it seem as though it's very new, these are actually very experienced investors who have been in venture capital for a long time and are executing a strategy that they're very familiar with. The other thing that I would say about the partners at this firm is that they have experience both as entrepreneurs and operators in the areas in which they're investing, which obviously makes them attractive and valuable partners to the companies that are looking for venture capital funding. So we think that this is a good team. They have worked together in some capacity for the past 10 years at least, and we think that they have done a good job of building their team as well. They recently added a younger partner who's a little newer to investing but has had good operating experience and who has already started doing some deals that are marked up very nicely in this portfolio. So with this recommendation, we are bringing, we think, a manager who is a good complement to what is already in the portfolio. We think it's a strong team. The track record looks limited on page 32 here. That's because, as I mentioned, Jackson Square became its own independent group and renamed recently. But if we look at the track record of the partners over the life of their investment careers, they were generating a 4.1 times multiple on invested capital in aggregate. So we think that they're a strong team and they're experienced in the areas in which they're investing. One of the things, or I guess some of the things that we wanted to note as considerations, first of all, this group did split off and start its own group. So they are still kind of establishing their brand as a new group, even though the investors have been in the game for a long time. And then also, one of the things that we note is that even though in aggregate the team has a 4.1 gross MOIC, the most experienced investor, I think, has been responsible for a lot of that attribution, though if you looked at the attribution for the other partners, it's also been very strong. With that, I would ask if there are any questions about this manager.
Thank you. Are there any questions about this investment? If there are no questions,
Younger partner was somebody like 65 years old, is that?
I think he's 30-something, maybe 34, yeah. A lot of wise people at 34.
so may I hear a motion to approve the following investment item? Investment manager for the University of Houston Endowment Fund. A $7.5 million commitment to Jackson Venture 2 LP. And do I hear a second?
Second.
All in favor, please say aye.
Aye.
The private investment manager recommended by Cambridge Associates has been approved by the committee. And now Cambridge Associates representative will be presenting item E. Following this item, I'll call for a vote.
So if you can turn to page 44, the recommendation we have today relates to the hedge fund portfolio, and it's really just a rebalancing recommendation. You'll recall over the past couple of meetings, as part of the strategic plan, some redemptions have been made for hedge fund managers within the portfolio. So today, in order to bring the program closer to the target splits that we like to see it have today, we have 5 rebalancing recommendations to existing managers. We will be using redemption proceeds to fund these investments. So it is a $2 million investment to Co2. I will just note there that Cambridge has recently negotiated a fee decrease for Cambridge clients, so something that's always good to hear in terms of lowering fees.
Because we know fees are certain and performance is not, as the saying goes.
A $3 million, so that would be on April 1st. A $3 million to Davidson Kempner on May 1st. $2 million to Brahmin on May 1st. $2 million to Highline on May 1st. And $1 million to Marble Arch, also on May 1st. Again, these are all existing managers where we're just looking to rebalance using hedge fund redemption proceeds that will be coming in.
Thank you. Are there any questions? May I have a motion, please, to the recommendations made by Cambridge Associates to invest into existing hedge fund managers as follows. Number 1, Co2 sector-focused long and short-term equity, $2 million on April 1, 2016. Davidson Kempner, event-driven, $3 million on May 1, 2016. Brahman, U.S. long and short-term equity, $2 million on May 1, 2016. Highline, U.S. long and short-term, $2 million on May 1, 2016. Number 5, Marble Arch, U.S. long and short-term equity, $1 million on May 1, 2016. Is there a second, please?
I'll move approval. I'll make the motion.
Second.
All in favor, please say aye.
Aye.
The above recommendations by the Cambridge in investing the existing hedge fund managers were approved. Please note that both action items D and E require committee approval only, and no further board action is required. Our next action item for the committee's consideration is item F, the approval of fiscal year 2016 University Advancement Endowment Assessment rate of 1.5%. Mr. McShane,
Thank you.
will you please present this item?
Thank you. Yes, the, this assessment of the endowment of 1.5% annually requires annual review and approval by the board. There's a slide on the following page that shows you what it has been over the last several years. The benefits, the bottom line is the middle column is the amount of the annual assessment. The last column would be taking the cash added back to the endowment divided by the amount of the assessment to give you a return on that assessment value, which would currently be 3.3 times the investment for the last fiscal year. To make it clear, there are some endowments that is not assessed against. It depends on the original endowment agreement with those donors. In some cases, the endowment agreement specifically specified that it cannot be, that it's not approved in that endowment. Have any questions?
Mr. McShane,
Yes, sir.
are there any other mechanisms where we might develop a more budget-focused approach to the fee, or is this kind of the common approach? It seems to generate volatility in this amount each year, and I'd expect a more consistent.
Yes, I would like for us to looking at a budgeted amount, and then if it takes up to the 1.5%, if that budget amount would meet the advancement's needs, then if it was 1.2% that particular year, it'd be more based upon the needs to supply them a consistent budget than the fluctuation of the percentage that's paid out, or the dollars paid out based upon the 1.5%. Because as you can see, 5 years ago, it was only $3.5 million versus we project 6.7 at the end of this year. So I'm sure they would like some consistency, would also want to be sure that they had a budget adequate to accomplish their goals.
Yeah, I'd like to see,
Yes, we can actually look at that during the budget process this year.
Are there any other questions? May I have a motion to approve this item as presented?
So moved.
Is there a second?
I'll
All in-
second.
All in favor, please say aye.
Aye.
all right.
This item is hereby approved. The next action item presented will be item G. The approval is requested to modify the U.S. System Endowment Fund Statement of Investment Objectives and Policies, U.S. System. Mr. McShane will present this item.
Thank you. We're recommending two changes to the endowment policy. It's primarily the payout policy. What we're trying to get to is a more consistent payout so that, especially at the department and college level, it better allows them to plan. If they know it's not going to drop significantly from one year to the next, they will hire chairs, et cetera. And if they're hiring a chair one year on a good year and suddenly we have a bad year 2 years later, they don't have that consistency in funding. So we're suggesting a couple of changes to address that. One is our policy is currently that if an endowment is less than its original principal value within the endowment, we would consider that to be an underwater endowment. So what we're proposing, what we do currently is we do not pay any payout on that endowment until the time at which it is back above, equal to or above its principal value. Many universities continue to pay on them regardless of, they could drop to 50% and they would still be paying the payout. What we're proposing is a mixed proposal that we've looked at what other universities have done. It's a very common business practice. And that would be if an individual endowment drops to less than 100% of its value, but greater than 90%, we would pay 3/4 of the payout. In this case, it would be 3% as opposed to the 4%. If they drop to between 80 and 90%, we would pay 2% or 50% of the full payout. Once they drop below 80, there would be complete discontinuation of any payout to them until they climb back above that 80, 90, or 100%. So that would, from what we measured this particular year, we would have had $5 million that would not have been paid out to any of those endowments that were underwater. And in fact, this year, we'd pay about $4.1 million out to those because they're not so low that they wouldn't receive a significant portion of the payout. The other thing we're doing is more of a technical adjustment than anything else. We currently calculate the 3-year moving average based upon the end-of-year balance for the previous 3 years. We're recommending we go to using the 12 quarters of that same 3-year period so that a significant fluctuation at the end of 1 year could have a more dramatic effect on the endowment, and this should be a more consistent approach to what the markets and the balances truly were over that period and would again provide a little smoothing or consistency of the payout. You have any questions?
Thank you.
So this would just slow down the rebuilding of it, but
Correct.
it would still be partially rebuilt.
Yeah, we would be preventing driving it any further than we had to, but and we find that our donors, from what I've seen, would prefer it that way as well. They don't appreciate it much whenever we're not paying out income from their particular donation.
And this seems to be consistent with how other endowments.
Yes, we've done Raymond's done quite a bit of review of it, and this is a very common practice, and based upon our review, and I believe also in consultation with Cambridge, they're supportive of this as well.
I understand there will be more distribution made than otherwise. From what I heard from Mr. McShane, that we are going to be shunting out more money than we have been doing before. Is that correct?
That's correct. The example I gave is actually in this upcoming year, the payout would have been $5 million less with our historical practice, but instead, since those endowments that are between 80 and 100% will receive a portion of that payout, we will actually only be withholding about $1 million, paying out $1 million less than we would have otherwise. So a $4 million increase in what it would have been under our previous policy.
Are there any additional questions?
Maybe just a brief explanation on the policy changes related to the state law. I know most of the policy changes recommended have to do with this change, but there's also a comment about the change related to just adjusting for state law, and I want to have just a brief explanation on that, but, before we vote.
All righty. Don, are you familiar with the legalities of this change on the investment?
Where there was a change in the investment policy related to a law recently passed by the legislature. It says,
Which page are you?
and, let me see what page it is.
I think Raymond has your answer.
Oh,
This is up MIFA.
Oh, okay.
Yeah, the law that was passed. And so what this is doing is, we went back and we looked at
Yeah.
what other universities have put into their investment policies. So I'll tell you right up front, nothing that we've put in that policy is different than you're actually doing today. It's really codifying what is in state law
Right.
and placing it in the document. And it addresses the things that you should be taking into consideration when making investments, the things that you should be considering when dispersing or paying out. It's just what is in state law. It's nothing different. And we shared and discussed that with legal counsel to make sure we were consistent.
Yeah, we went through all of it.
okay. Thank you.
You're welcome.
Any other questions? May I hear a motion to approve this item as presented?
So moved.
Thank you. Is there a second?
Second.
All in favor, please say aye.
Aye.
Thank you. This item is hereby approved. Our final action item today is item H, the annual review and approval of the U.S. system investment policy for non-endowed funds, U.S. system. Mr. McShane, will you please introduce this item?
Yes, thank you. The state law, as well as our own policy to support state law, requires that annually the board review and approve the non-endowed investment policy. There are no changes to the policy other than the date at which it's been reviewed and approved to what we're proposing. Are there any questions?
May I hear a motion to approve this item as presented?
So moved.
Is there a second? All in favor, please say aye.
Aye.
This item is hereby approved. Following the approval of this item by committee, it concludes the presentations of the three action items presented today requiring board approval. I would like to make a motion to place these three action items unanimously approved by the committee by requiring full board approval on the board's consent docket agenda as follows. Number one, approval of the fiscal year 2016 University Advancement Assessment Rate of 1.5%. Item number two, approval is requested to modify the U.S. System Endowment Fund statement of the investment objectives and policies. And number three, annual review and approval of U.S. System investment policy for non-endowed funds. Do I have a motion, please?
So moved.
Is there a second?
Second.
All in favor?
Aye.
Thank you. These three items are hereby approved and will be placed on the board's consent docket agenda at the board meeting held later today, February 18, 2016, for final board approval. The final item listed on your agenda item is item I, the report on the University of Houston Systems invested funds and bank deposits. Mr. Bartlett, Senior Associate Vice Chancellor for Finance, will you please present these items?
Yes, thank you, Regent Agrawal. So if you'll, on page 177 in your iPads is a summary report of all of our non-endowed. So you've heard from Cambridge today about the endowment, and this report just summarizes everything that we have under the U of H system umbrella in terms of investments, both the endowment, the non-endowed, bond proceeds, and debt service funds. And so, in summary, we've got $1.2 billion as of the fiscal quarter ended November 30, 2015. The majority of it, of course, is between the endowment and our non-endowed funds. Our non-endowed funds are split generally equally between daily liquidity, i.e. money market funds, which are AAA rated, and then in a very short to intermediate term fixed income fund that is managed by an outside firm. We do have $81 million in bond proceeds. Those, of course, are used for capital construction and ultimately go to zero as we draw down those funds to pay for the construction projects. So in total, again, $1.2 billion as of November 30, 2015. Any questions?
Thank you, Mr. Bhatt.
Thank you.
This item was presented for information only and no committee action is required. This concludes our presentation today. It should be noted that an executive session will not be held. Does anyone have any further questions? If not, there being no further business to conduct before this committee, this meeting is hereby adjourned. Thank you.